Hello. So today we are going to be analyzing Indus Infra Trust. This is an Indian company and specifically it has been classified as an infrastructure trust. So this company or this trust invests in infrastructure assets like highways, roads. They do not construct them. They don't do that. They're not involved in construction or anything like that. Not even in engineering or anything like that. They're involved in just financing, not even the project. So it's a pretty interesting business model. The aim of today's segment is to just give an intro to what the company does, its financials, and all that. So let's take a look. First, we have market cap of 5,268 crores. So not the biggest company, pretty small cap. Current price of one share is 118 rupees. Okay. The book value of one share is 110 rupees. Book value is assets minus liabilities. So book value per share 111 rupees. Return on equity of 9.38%, which I guess for an investment trust, infrastructure trust is nice. It's all right. And return on capital employed of 9.32% with a stock price to earnings ratio of 10.7. This company was listed or had its IPO in 2024. So it's only been listed for like a year on the stock market. All right. Here we have the profit and loss statement of the company, and you can see it starts from 2024. So we don't have a lot of information. All right. In 2024, we have sales of 121 crores. Okay. We have operating profit of 37 crores, operating profit margin of 30%, profit before tax of 20, and finally a net profit of 15 crores. Okay. Then we move to next year or the latest year, fiscal year 2025. We see revenue jump astronomically to 745 crores. Operating profit to my right, 521 crores. Operating profit margin certainly jumped up to 70%. Profit before tax, 503 crores. And finally, profit after tax of 482 crore rupees. So pretty interesting financials. Now, we don't have a lot of information, at least on screener.com, we don't have. So let's jump directly to what the company actually does. Okay. And the company does have stable, good cash flows. That's a plus. So this is a very simplified model of what the company actually does. Okay. So we have Indus Infra Trust. It will first buy, okay, pay attention to buy. It will buy a special purpose vehicle. Now, if you're wondering what a special purpose vehicle is, think of it like this. Construction company constructs, let's say, a highway. There will be an SPV or special purpose vehicle, which is like a part of the company. It's a subsidiary of the construction company, and that SPV will own that highway. Correct? It will come under the balance sheet, and the money to be received for the highway, construction of the highway, the SPVs are going to receive them. Kind of like that. So, oh, my fault, yes. So, Indus Intra Trust buys out these SPVs, these companies from these construction companies. All right, so it's not involved in the construction. It buys out these SPVs. And let's say a highway, like a particular highway, they have bought out. So they have bought out a SPV. That SPV has the highway basically. Okay, if that makes sense. And the money to be made from that highway, the SPV is going to make it. So it buys out the SPV. Okay, and here it's written the SPV, it has built or it has bought an infrastructure like a road or a highway, and it's built under a ham model, which we will discuss. Okay, ham model is hybrid annuity model. Don't worry about it, or we can worry about it. It's basically we are constructing it. It's a method of financing project. Here, in under a ham model, 60% of financing of a construction project comes from the construction company, and 40% comes from NHAI or the National Highway Authority of India. Okay. So this SPV has either built or bought this infrastructure project like a highway under a ham model, mostly under a ham model, and it has provided 60% of the money construction wise. 40% has come from NHAI. Now, NHAI will give this company annual payments. Remember, hybrid annuity model, HAM, the A, annuity, annually. So, annually payments will be given by NHAI to this SPV, okay? And it will also provide operation and maintenance money. So, a highway needs operation, a highway needs maintenance and repair. So, for that money, they will also provide money, the special purpose vehicle. Now, Indus Infra Trust, it has already bought this special purpose vehicle. Now, this SPV does have loans. Okay. In order to make sure that all these old loans before buying it, the old loans this SPV had before Indus Infra bought it, what does it do? It provides them with a loan. So next to buy, there is a loan. See, loan. It gives these SPVs a loan, and basically this loan can be used to pay back all the previous loan. And now the SPV only has one loan. That is Indus Infra's loan. So this SPV gets these cash flows. Okay, they get these stable annual cash flows, predictable cash flows. Okay, from NHAI, and gives them Indus Intra Trust in the form of, let's say, interest payments for the loan they provided, and sometimes even dividends and all that. Okay, so that's the money. So Indus Infra Trust receives money in the form of interest payments, in the form of dividend, and also paying back of the principal amount itself, principal amount of the loan, that is paying back the loan, paying back the interest of the loan, and dividends and all that. Now, one important thing, uh, I mentioned stable cash flows. When we mean stable, predictable cash flows, here it really means stable, predictable cash flows, because this money that they're providing, right, these annual payments, they're already written in a contract. They're already written in a contract, so it's predetermined and it's inflation hedged. So as cost rises or inflation occurs, this money, these payments are also increased according to that. Inflation hedged. Yes, inflation hedged. So these are really, really predictable cash flows. That's the plus. So we looked at what the company does. It's a very brief, potentially wrong way of telling what the company actually does. But now let's see more financials and important data about the company. Yes, so we have the consolidated financials. Now, again, this company is a trust. So, of course, we have these like total income, EBITDA, profit before tax. That's all important. Let's just take a look. So, for quarter one, fiscal year 2026, um, yeah, I can't read these months. Okay, 36 2025. What do we have? We have total income of 2044.88 millions of rupees. So all these figures are in millions of rupees. So 204 crores. EBITDA of 167 crores. So extremely high EBITDA. Extremely high EBITDA percentage, because again, see, it does not construct, it's not constructing anything. It's mainly providing money and it's getting it back. And there's some other related expenses, but extremely high margin, because it's not constructing, it's not involved in construction. Profit before tax 124 crores and net profit 120 crores. Now, the main important thing here, the main important thing here is this and this. INVIT, which is Indus, the INVIT Infrastructure Trust, NDCF. You see this? NDCF. NDCF means net distributable cash flows. And this is extremely important, okay? See, it's written here, net distributable cash flows. These infrastructure trusts, right? Let me just go back for a second. Um, yeah, I've written it down here. Yes. Infrastructure trusts. Look under the orange thing. The infrastructure trusts are required to distribute at least 90% of the net distributable cash flows to unit holders to generate steady income for investors. Here, shareholders are called as unit holders. So they're basically the same thing. So 90% of all the cash flows that this infrastructure trust will make, it will all go to investors. At least 90%. This is permitted by law. They have to follow this. So bringing back here, okay, going back to this place, we see the net distributable cash flows, okay, of 147 crores. Again, these are in millions of rupees, so convert them to crores. 147 crores. And remember the market cap of 5,000 something crores and price of one unit of one share is 118 crores. Sorry, 118 rupees, 118 rupees per share. Now, if you go here, uh, I hope I'm correct. Yeah, here it's saying DPU, distribution per unit, 3.25 rupees per unit. Now, this is for this quarter, okay? So, quarter one fiscal year 2026, it will distribute 3.25 rupees per share. 118 rupees per share, 3.25 rupees the unit holders or shareholders will get in this quarter. If you multiply that by 12, if you multiply 3 by 12, sorry, it's per quarter, right? It's per quarter. If you multiply 3 by 4, so one quarter we get around 3 rupees. 4 quarters or one whole year we get around 12 rupees. So unit holders can expect to get around 12 rupees of basically cash flows or money directly from this company on a price of 118 rupees per unit. Okay. Now here you see is written interest, dividends, and return of capital. So this distribution per unit, right, DPU has been divided among these three categories. The biggest thing is interest, then dividend, and return on capital. Basically, when unit holders, right, they will get this money. Let's say you are a unit holder. You get this money, 3.25 rupees. 2.78 rupees interest that you receive of this 3.25 rupees that may or may not be taxable. It depends on a certain feature. Dividends are taxable. Like you get this money, you will be taxed. And return of capital is actually not taxable. Okay, so this 0.43 rupees of every 3.25 rupees, if you are a unit holder, then you will not have to pay any taxes. Interest, it depends. It depends. There is a certain condition for that. And dividends, yes, they are. So again, just to say it again, 12 rupees of cash you're going to get from the company on a value of 118 rupees. So more than 10% yield you're effectively getting. And that is pretty common for infrastructure trusts like this. Moving on. Now let's look at the financials and all that. Okay, enough yapping. Okay. The company has got a triple A rating. My face is too big. Yes. So Chrysler and Care Edge, both are credit rating agencies, have both given it a rating, have both given this company a rating of triple A and stable outlook. Then total debt. Total debt we see, okay, in millions of rupees is 21,137.51 rupees, millions of rupees, which is 2,137 crores, 2,137 crores of total debt. Again, the company has so much debt because it used this debt to actually, buy these SPVs. All right. And it will get money from the SPVs. So it goes like that. Um, then moving on, let's move on. Asset portfolio, the asset portfolio of the company. What are these SPVs they actually own? Okay, so this is the asset portfolio of the companies. So in state of Punjab, we first have the GR Pagwara Expressway Limited. Okay, then we have another one in Gujarat, another Gujarat, Maharashtra. Okay. We got one in Uttar Pradesh. We got one in Uttar Pradesh, Bihar, and Andhra Pradesh. So we got 9 SPVs. All right, we can see these are number of highways. All are highways actually. The length seems to be 69 kilometers, 49 kilometers. Okay, pretty long highways it seems like. So we got nine nine SPVs. Is it nine? Yeah, nine SPVs. You got nine SPVs currently the company has. And remember that massive jump in revenue you saw earlier from like 100 and something crores, 121 crores to 745 crores in 1 year? That was because it acquired these SPVs. So if it acquires more and more SPVs, it will see that growth. But with the same number of SPVs, it won't see a lot of growth at all. The company won't see a lot of growth. So 121 crores to 745 crores increase was mainly because it was only because it had acquired a lot of these SPVs recently. So yes, in order to grow, the company will need to raise more money and will need to uh, buy all of this, buy more SPVs. And yes, here you can see maximum leverage debt to enterprise value allowed up to 70% currently and 30%. Okay. For an infrastructure trusts like these, the maximum debt they can take up, leverage they can take up is 70% of enterprise value. That is a different statistic. This is market value plus debt minus cash and cash equivalents. Basically, there's a certain amount of debt you can take up. But this company is currently at 30%. Okay, so on the leverage point, it's way below the maximum that it can take. So that's a good thing. Not a lot of leverage gets taken. See, not overly leveraged, which is good, which is good. Not a lot of debt. So let's move on. Okay, project details. Project details. Yes, we got nine HAM projects. HAM, we know what HAM means, hybrid annuity models. 617 kilometers total length. Okay, 9.66 to 13.78 years of residual concession period. So I guess these projects, these SPVs, right? How many years will they get the money for? So 9.66 to 13.78 years of stable cash flows from these current nine projects. Okay. Now pay attention to, please pay attention to this one. Annuities receivable as on June 30th, 2025 in millions of rupees. So on total, this is the figure. 72,294.22 million rupees or 7,229 crores. So the current cash flows still outstanding, or it can is expected to receive in the next 9-10 years is around 722.94 crores. So 9 to 13 years in that range. So annually wise, I can't see my calculator. That's somewhere around 700-ish crores, 600-ish crores of cash flows it can expect around annually from the current SPVs it has. All right. So again, in order to grow, it will have to buy new SPVs. Okay. Also, remember, the company doesn't have a lot of maintenance capex. Okay, to maintain its current assets, how much capex, capital expenditure, the company would need. It doesn't have stuff like that, and stuff like working capital changes. Pay like trade receivables, trade payables. The company doesn't have to worry about those things because again, all it does, or majority of the thing it makes money from is just buying SPVs and the SPVs providing stable cash flows to them. And of course, providing managers to these SPVs, I think, in this infra trust does provide. But the main thing I'm trying to say is that little to no maintenance capex, this company, little to no working capital changes. So around, as we saw earlier, 140 crores of net distributable cash flows. To multiply that by four, which is around 14, 20, 48, 500 crores ish, 500 crores ish of net distributable cash flows it's getting. So it will not be affected a lot by working capital changes or even by what else? Working capital changes or even by maintenance capex. So basically, compared to market cap of its 5,300 crores, it's getting some great cash flows as expected, as expected. That's all I wanted to say. Then moving on, we have, yes, the total value, the current total value of its nine HAM projects is 6,969.2 crore rupees. All right. Average concession, balance concession life of 11.13. I guess average, how long will these last? 11.13 on average. Moving on, here we see who owns the company. Yes, yes. First, GR Infra Projects. Now, it's written here the transferor. So I guess they may have a bit of stake in the company, but these SPVs that they get, the SPVs that have these highways and all, they are from GR Infra Projects. So GR Infra Projects is the one providing these SPVs for sale. Okay. Then we got Ardhashila Infratech Private Limited, which is the sponsor and project manager holding 15% of the company. All right. Okay, part of 15%. Yeah, yeah. And public unit holders or investors make up the majority, I think so. Of yes. We got a few more investment managers, we got trustees. Uh but yeah, important thing, who do they get the projects from? GR Infra Projects. So, moving on. We go to yes, strategy. Strategy. Now, expanding assets. Expanding assets. Okay. They currently have a proposed ROFO agreement, right of first offering. So if GR Infra Projects, right, they're looking to sell one of the SPVs, then uh, Indus Infra Trust has the right to make the first offer before any other bidders. Okay, before any other bidders can come, they have the right to make the first bid on these projects. All right, it's a right. It's a right. Right of first offer. What are these offers for? This right of first offer accounts for 21 additional road assets owned by GRIL. Okay. And any road asset that GRIL may acquire over the next 5 years. Okay. 21 additional road assets. And currently it has nine SPVs, highway projects. Okay. 21 additional road assets. Then their comparative strength. Comparative strength. Again, right of first offer with GRIL. We already discussed that. 21 new roads, any new road projects over the next 5 years. Yeah, steady in nature of income with predetermined annuity payments with zero traffic risk. What do you mean by traffic risk? Which means that roads, right, highways, they collect tolls. But if the traffic is low, less toll revenue. That's a risk, not for them. Their payments, the payments that's received from NHAI, right? The SPVs, the payments they receive from NHAI, they do not depend on this traffic, do not depend on the number of people. It's under a ham model. Ham models do not do that. So the cash flows are predetermined, they're written on a contract, stable. And of course, yes, all assets are on ham basis. So nothing like EPC, nothing like BOT projects. No, no, no. Only a ham basis. The entire revenue to continue from annuities paid from NHI. So all the revenue is basically the payments by the NHI. Okay. Finally, okay, that was it. Yes. So finally, let's talk about what management said for future growth. How is the company going to grow in the future? This video is already 24 minutes. That's not good time management by me. Okay. First, we have this. Uh, this is said by the management of the company. So someone on the management team, this is the con call. This is a con call. So management said, so I think with the acquisition of these two assets, of course, our DPU, distribution per unit, has also bumped up. So I think this year we're looking to distribute of around 12.5 rupees for the year. So 12.5 rupees for the entire year per unit or per share. Current value is 118. So more than 10% yield people can potentially get. DPU, distribution per unit. Okay, 12.5. 5 rupees, and they mentioned acquisition of two new assets. And we will talk about these assets. They mentioned this, okay? Mentioned the growth and all that. We are trying to figure out their growth. Then moving on. Yes. So a question was asked to the management. Question is asked, sir, on the asset acquisition side, now this year we have done this recent one that we announced. What is the sort of guidance for asset acquisition for fiscal year 2026 and 2027? Very important. Again, the company can only have significant, meaningful growth by buying new assets, by buying new SPVs. It's a very important question. So, what is the answer? For this fiscal year, asset acquisition guidance is almost including GR infra projects, and even non-GR. And I think we will acquire 5 to 6 assets this year. So they currently have 9 assets, and they're going to acquire 5 to 6 assets for this fiscal year alone. Okay, that's significant. So the question continues. That would be significant, right? I mean, compared to last year. Yes, a very important question. The leverage currently is 30%. So where can we reach after? Where can we reach after acquiring these 5, 6 assets? So the answer is below me. If we do not raise any equity, I think a leverage ratio should touch around 55% odd. So they think the leverage ratio without raising any equity would be around 55%, somewhere around that, and the maximum allowance is 70%. So they still have like a 15 percentage points of margin safety, basically. So currently 9 projects, and this year 5 to 6 projects. So that should lead to some significant growth. Maybe there. I'm not saying it will. Okay, I'm not saying it will. They are saying it. They are saying it. It will lead to some significant growth. Okay. Then finally, we have only a few more things to see. Yes. Here. Question is asked. Question is asked. So, could you quantify what is the size of these 5 or 6 assets that we are targeting? What would their enterprise value? Just trying to calculate, and what our enterprise value could be at the end of fiscal year 2026. So, some rough number. Enterprise value, it's a financial thing, financial term, a market cap plus debt of a company minus cash and cash equivalents of a company. I think so. And it's a number they use a lot. Indus Infra Project Trust does use enterprise value a lot. So answer is 4,000 to 4,200 crores of addition to the enterprise value. And the current enterprise value to my left, 7,000 crores. Current enterprise value is 7,000 crores. It will go up to 11,500 crores. Yes, yes, 11,500 crores. So significant growth in what is this? This is around 50% growth. Yeah, more than 50% growth, which is very significant. And of course, 55% of debt of this would be debt, so it could be around 5,500 crores of debt. So that was Indus Infra Trust. That was the entire segment. It's an interesting company because again, its main expense will of course be its interest payments because again we saw that it has 2,000 something crores of debt. So interest payments will be big portion of it. Its growth relies heavily on cash flows. I guess the net distributable cash flows being around 130, 140 crores a quarter compared to market cap of 5,300 crores, getting around five, potentially 500 crores of cash flow, actual cash being given to investors. Is that good? You can, that bad, is that bad or good? You can decide. And very stable cash flows because it's written into the contract, and 9 assets, they're going to be buying 5 to 6. So maybe, just maybe, we can expect a 50% growth rate in revenue plus profits coming in the next 2 years as compared to this year, just based on their buying the assets. So of course they will get that revenue jump if they do successfully execute these plans. So that was it. Indus Infra project, sorry, Indus Infra Trust. What are your views on the trust? And that's it. Hope you liked the segment.